Hello, everyone, and welcome to the MakerDAO Quarterly Strategic Review. This is a review of Q1 2022. My name's Peyton. I'll be doing the slides, but we'll be passing it over to Strategic Finance to run the show along with some others. Mark, if you want to take it away, happy to be your slide clicker.
Awesome. Thank you, Peyton. Hi, everyone. This is Mark Phillips, also known as AES on the Strategic Finance Core Unit. And welcome to MakerDAO's Q1 2022 QSR meeting. Speaking today will be Nadia from Growth, Jan from Risk, Sam from Protocol Engineering, TJ from Real World Finance, and Seb, Adrian, Dan, and myself from Strategic Finance. We highly encourage participation throughout today's call. And if you have a question, please raise your hand and Peyton will help facilitate. Next slide, please. And as we usually do with our financial and data presentations, we have a brief legal disclaimer. Please read at your leisure, but high level. This presentation is provided for informational purposes only. It does not constitute financial investment, legal, regulatory, or tax advice. All right, I will kick things over to Seb on the next slide.
Yeah, thanks. So as you can see on the KPIs scorecard, which represents the main metrics we want to follow at MakerDAO, as we have decided as a community earlier. We can start by the lending metrics, which is kind of the core of the business providing revenues. We can see that on the market share for crypto lending, we are kind of flat to down month over month and year over year, both for the ETH market share, which is down to 43%, and the VAP Bitcoin market share, which is down to 29%. Which this one is still up from last year, which was 22%, but down sequentially for the last few months. Real world assets are quite up, still a small amount, 30 million, but plus 55%, and that's due to mainly to success at growth credit line. The net recurring income is down due to a volume effect, less loans, but as well as lower stability fees. So both are negative for the business. So that's why this number is quite down. Yet we can mention that the breadth of users remain kind of the same. So no shrinkage here. We have still around the same number of active vaults, even if it's still down since last year. And the new customer growth remain constant, even if it's very low. On the DAI metrics, so that's the DAI demand. We can see that we are kind of flat, growing slowly since the last year, both in market share, so the amount of DAI outstanding, and the transaction market share, so the circulation on-chain of DAI, which are respectively at 5.3% and 9%. It was always roughly 5 and 10%. Risk-wise, so generating profits, but what is the risk of this generation of profits? Here, everything is kind of perfect, sadly, because we don't have enough business. The capital at risk is very low at 18 million, which is 1/3 more, even more, less than 1/4 than the surplus buffer. We have a very good collateral ratio distribution for the vaults at 340%, which is increasing sequentially. And the collateral asset liquidity, the on-chain equity, is quite strong as well at 30%. Sorry. Next slide, please. We will now look more specifically on the financials. If we remove the effect of a liquidation, obviously there was a big crash in January, so that's created a lot of revenues. But if we remove this line, we are down on most items. The reason is net interest income is down because the amount of loan is kind of shrinking since Q4, but still increasing since Q1 2021. And the stability fee are down since Q1 2021, they were 5.5%. But we have a higher volume, so that's why the net interest income is still bigger than last year. Sadly, compared to last year, the main issue is that the main reason of the diminishing of the net protocol income and the recurring income is the fact that we have core units that are taking most of the cost. So most of the revenue are now headed toward the core units. So that's why the recurring income is a bit down. But if we remove this effect, we will still be better off than last year, especially if you suggest that core units were still already there, but paid by the foundation in Q1 2021. We can also highlight that the first curve LP was published or in production. So stake is, and the finished stage of deploying fast withdrawal on Optimism and Arbitrum. And we hope soon component D3M. And last point, but not the least, the maker price is up over 1 year period, which is still good. It was obviously at the end of Q1. Now we are way below that. And it was still decreasing since the end of the last year. And that's for me on this slide.
I will pass things over to Adrian.
Cool, thanks, Mark. So we talked about these, we took these slides through at the last decentralized voter committee. So one thing that we're trying to do as we get to as we look forward through to the end of the year is we're trying to get a little bit more reactive in terms of where we think the market will go and how that will impact on the profitability of the protocol. So the way that we are looking at this and thinking about this is we've thought about it in terms of a base forecast, a bear forecast, and a bull forecast. All of them have the first sort of quarter of the year in the actuals, and then we're driving the scenarios based on different assumptions for the amount of ETH and WBTC tokens that we have collateralized on the platform and their corresponding DAI price, along with some assumptions on the stability fees. So the net picture is that overall the protocol is still operating at a very high return on equity and operates at very high levels of operating efficiency, particularly when measured against our TradFi counterparts. In the base scenario, so in the bear scenario, let's maybe start with the fun part. What we've assumed is that all of the collateral types slide on average 75% from whatever the balance was on the 26th of May. We will further assume that there are no new business initiatives and that we are also collecting slightly more liquidation revenue behind, more volatile prices, closing out some of these books. The bull scenario, the hopeful one, is a V-shaped recovery in crypto markets, more, maybe or more or less likely, but here the underlying business you would expect it to bounce back both in tokens collateralized and in the underlying asset price. In the base picture, what you see is so on the top line, you have the total balance. You can assimilate this to a sort of DAI outstanding on average throughout the year 2022 as a result of each of these scenarios. Then moving down the table, you see the revenues that these balances generate. You have crypto lending revenues, largely ETH and WBTC, real world asset revenues, D3M, shorthand for direct integrations with other protocols, all other revenues, and then a new products line for institutional vaults, new integrations with other protocols, and Maker on multi-chain and layer 2s essentially. So this adds up to give our total interest revenues picture. On that, we add any trading fees or trading revenues, which for now are zero, but could be a source of revenue in the future, but mostly this is liquidations. And then below that, we have what we call asset productivity revenues, which is essentially interest earned on the asset side of our balance sheet, namely from initiatives such as investing in the short-term bonds, like MIP65 should start over the course of the next half of the year. We've projected out our best estimate of sort of cash expenses for the full year 2022, and then we also do we also take out the DAI value of the maker compensation on a now outdated maker token price to produce a net protocol income and a recurring net protocol income, which only takes into account the interest rate. I don't know if this is useful for everyone. In case there are any questions or comments, happy to stop here. Otherwise, I think we can move forward in case there are no further.
Not seeing any hands in a moment, but as a reminder, you can either raise a hand if you want to ask a question live or drop it in the chat and we'll get to it.
That's great. And so here we're essentially doing a double click on one of the scenarios, the base one, where you see the difference in from January to April and May to December. January to April being the actuals and May to December being the rest of the year, the balance for the rest of the year. So here the main difference is obviously the change in balance. So what we saw so it's been quite a bearish year from the beginning of January, but the trend accelerated from the end of April and throughout the month of May. So this explains the difference in total balance that we see. The overall average for the year should be around 7 billion DAI, bearing in mind that the actual figure at the end of the year may well be different. What we're seeing in our base case is we have a rapidly compressing macro environment. So rates are rising off chain, and there's a general sense of risk off as stagflation starts to take hold and numerous geopolitical risks are shocking different financial markets, as well as draining price levels in crypto. We're also very subject to the vagaries of the lending market within crypto. So to this point, I think the real world assets in the long term will have a role to play to stabilize and de-risk some of this exposure. These revenues are highly correlated to the price of ETH, and they are further subject to demand for lending. Yeah, so overall, the picture is a landing estimate of about 50 million DAI accumulated in the surplus buffer, all in, largely behind quite a challenging back half of the year, but all in still fairly decent result if you compare it to some of our TradFi counterparts. But I think this is a topic for another discussion. Here, I'd like to call out, just before we move the page, the asset productivity revenues. You'll see they're 0 at the beginning of the year, and they go up to 12.1%, 12.1 million. So this is purely an estimate on our side based on the yield that we could conceivably generate through MIP 65 and through investing in short-term bonds. So this will depend on the yield environment. We're assuming it'll be relatively stable for the rest of the year. And it'll also depend on the amount of capital that we are able to get working. So I think this line almost on its own speaks to the importance of managing our balance sheet prudently and in a systematic fashion. I think MIP 65 is a very good first step, and I think we should keep going with other alternatives to keep extracting some yield out of our assets in a as close to a risk-free manner as possible.
Awesome, thanks, Adrian. Turning over to the expense side of the income statement, I'll briefly cover the Q1 3+9 forecast before turning over to the 4+8, since that data is a little more relevant now. So in our 3+9 forecast, we forecasted about 65 million in total expenses, 44.1 million coming from DAI workforce expenses, 3.2 million from articles, and 17.3 million in maker compensation expenses, which was based on a maker price of 1,650. Next slide, please. We're currently forecasting about 60.5 million in expenses for the full year of 2022. This is driven by DAI workforce expenses of 43.2 million, about a 900K decrease from last month's forecast, 3.1 million in oracles, and 4.2 million in maker compensation based on a maker price of 1325. The 46.3 million in DAI expenses are forecasted. Forecast for the year are a $12.9 million increase from the Q1 run rate. 36% of that increase is driven by real finance, and their expenses are likely to be correlated with the borrower pipeline and therefore, future revenue, assuming acceptable deal terms are reached with the counterparties. So, if we're reviewing more RWA deals, hopefully we're onboarding more and therefore, driving revenue, shortly after those expenses are made. We've also included an assumption about new core units being onboarded, primarily from SES based on historical new core unit budget requests. And this represents an additional 2.5 million in expenses in the second half of 2022. One of the small benefits of being in the bear market is that we are seeing Oracle gas expenses come down. And I know Nick and the Oracle team is working hard on reducing those on an ETH basis. So, as we move on to L2s and such, we'll probably see an increase in overall gas expenses, but hopefully as those technologies are improved over time, we'll continue to see that expense decrease. Next slide, please. One area we wanted to provide some more visibility to, and we covered this on the Centralized Voter Committee call with Rune, but for those who didn't attend, we'll go through this slide again. But we essentially wanted to provide some visibility to what we call operational reserves. And these are funds held in core unit wallets. So even though we report these on our financial reports, they don't really show up on MakerBurn unless we're digging into each of the core units' respective wallets. And most people are mischaracterizing the runway and only looking at like what's in the surplus buffer. The reality is each core unit and our gas expenses have quite a bit of funds tied up in them, and those will provide a sufficient runway or decent runway relative to only looking at the the funds held in the surplus buffer. So as of the end of May, we had 15.3 million DAI in operating reserves. This is nearly 6 million or 6 months of runway relative to the last 3 months of actual expenses incurred by core units. And this is quite a healthy amount of cash. And from my perspective, the financial operations of core units today are quite inefficient. Core units have a lot of flexibility with their budgets right now, but we believe there's excess capital tied up in these wallets. To date, GovAlpha is the only core units that's returned excess data to the protocol. And one of our motivations for the MIP 40 revision is to increase that to the broader core unit teams and ensure we are only tying up capital that's really needed for at most the next 3 months of expenses for core units, so we can more accurately reflect the situation in the surplus buffer and start to make capital allocation decisions a little more efficient. Because there's a big difference from looking at the surplus buffer at 76 million versus 91 million plus. In consideration of that, we probably have a little more runway than a lot of people expect. And I'll now pass over to Adrian to cover a bear doomsday type of scenario that we also covered on the DCV last week, or DVC.
The centralized voter committee, yeah, DVC. So I always get the fun slides. So here we're walking through what we're calling a super bear scenario, where everything basically nukes. So we're crashing the price of ETH by 90%. We're crashing the price of Bitcoin by 90%. We're reducing almost all of the remaining vault types. We're reducing the PSM by half. In this scenario, in this sort of catastrophic super bear scenario, the way that we've figured the runway is that there are approximately a 3-year runway for operations, which gives Maker the ability to weather an extended multi-year bear market. Now, so this takes operating reserves as quite junior capital, so we're assuming that we can tap that first before dipping into the surplus buffer. And the other thing is, this doesn't necessarily mean that we should take our hand off expenses and be complacent, because at the end of the day, this is just an estimate at this point in time. Conditions may well be worse than this. And in any case, I think we need to orient towards allocating the spending to its highest ROI use in any case, to extend that run, not just extend that runway, but also make the most of the capital that we do have allocated as core units. So yeah, last bullet point, obviously in the event of an actual major crash, we would recommend an emergency meeting to review the budgets and make the necessary cuts to try to increase that runway even further.
Hey everybody, Jan here from the risk team. Just to extend the points that already Seb made, capitalist risk has decreased significantly in Q1 compared to Q4, and there's a couple of reasons for this. And I want to first address the point of capitalist risk's volatility, because I think in the forums it's been mentioned once or twice that that's an issue, that capitalist risk is quite volatile, but we believe that capitalist risk's volatility is its feature, not a bug, because the market has been changing rapidly and in a lot of ways. And let's say debt exposure is just one of the things that decreased recently, but there's other things that have really, let's say, positively impacted the decrease in the amount. So that's basically the first thing. And then also that capital risk is always, let's say, when we're monitoring the capital risk, it's always on the current state, let's say, of the portfolio, the ecosystem, and the market shock that we're simulating. And if we, let's say, want to answer questions such as what kind of a financial buffer we should have, it's always assumed a couple of things that we're also modeling in our models. And that's why one of the recommendations that we've had before was to take Q4 average capital risk, because that's the kind of state that we've modeled before. But yeah, as I mentioned, this is kind of tricky because forward looking, as we've seen before with the scenario modeling, it's a lot of things can change, and let's say the bull market, the bear market, and so on, and that obviously also changes the capital risk metric. Apart from that, also we published like a feature analysis, what kind of signals impact the capital risk metric. And let's say the first most significant one is liquidity, then share of votes protected, which is another model that we're using under the hood to basically calculate the risk premiums via the collateral risk model, and then the debt weighted collateralization ratio, and in the end debt exposure. And this indicates how difficult it is to basically just model the increase or decrease in that debt exposure, and then to determine what kind of what amount of capital, what amount of financial buffer we need from there, right? Yeah, so this is all from this slide. Next slide, please. When it comes to the decrease, again, we've seen a huge decrease in the capital risk. In the beginning of Q2, we've seen some increase, but just to run through the main reasons for it. The first reason is that obviously the portfolio debt exposure has decreased by 1/3, which decreased the capital risk. Then the liquidity score increased for ETH and WBTC. So that's basically just looking at all of the exposure that we have, let's say if A, if B, and if C, and so on. And then we check that amount with the slippage, and then we measure that in the liquidity score. And that's something that we're that's embedded in the models. The third thing is that the debt weighted collateralization ratio also increased for the two major vol types, and then also the share of votes protected increased. And the main reason for this is that whale dominance increased in this period, and also the Flippy Friday stress test, because a lot of votes protected themselves during this period, and that basically showed us that they're able to protect themselves certain new votes, and that increase their basically improve their risk score. Let's say from medium risk, low risk, or high risk to medium risk or low risk, and that basically decreased the computed risk premiums, right? So that's one thing, and recently we've seen, let's say, a huge decrease in exposure in Nexo, which was a huge chunk of debt assigned as low risk, and that basically also increased recently the capital tree. So the volatility is basically just many different dynamics that are monitored, and yeah, the volatility makes sense given all the changes that we've seen in the last quarter, 2 quarters. Yes, that's it from my side.
Hi everyone. So I'm going to go deeper into what everyone just mentioned, but from the business development perspective. So what we have seen, as everyone said, we have seen how the DAI supply was reduced because of the current situation of the market. We have seen also a lot of positions that has been winding down because of the same, and also like because of the current market situation, we have seen how the collateralization ratio has increased. At the same time, during Q1, we added a new whale to the list, which is Gnosis. And the first reason why Gnosis is using MakerVaults is because they have a treasury management team, and the MakerVaults are part of their treasury strategy. That is one of the reasons, but also because they want, now that Gnosis is like rebuilding the Gnosis chain, the XDAI chain that was called in the past. They want to work on a more close partnership with Maker to improve the Gnosis chain usability and to increase DAI demand through the Gnosis chain. You can see on the forum a proposal that the Gnosis team posted in their forum, but they also reposted in ours, that talks about a close partnership between both to promote DAI. They are even proposing to rename XDAI to DAI, so we can work together and use Gnosis chain as like a very powerful side chain for Maker. So that is regarding the new whale, but also as someone mentioned before, Nexo has reduced their exposure in Maker, and it is because of the market situation. We have been talking with them. The institutional vault for Nexo still exists, but we have to repropose new terms because the terms that governance passed were approved almost like 10 months ago, so we have to renew those terms. And we also, as you all know, are talking with other institutions, but same, because of the current market situation. These conversations about opening an institutional vault are more like are having like a more slow response because they want to like understand what will happen with the market. Also, like the lending market in general has kind of slowed down compared to last year. So we also saw that WBTC market share was reduced during Q1. That was mainly because of Celsius winding down their position. But after the Terra collapse, because Celsius was very close to Terra, after Terra collapse, we have been talking with them. And the idea is to do something and think about a more close relationship with them. So you can see that as well on how they are using MakerVaults again. One interesting thing, and I think is like a good thing about Maker being so cautious and the most secure protocol, and that we are constantly like evaluating everything, is that right now, at least when I was preparing these slides, Maker was the #1 DeFi protocol by TVL, and it's the only one as well that is just deployed on Ethereum. So as I said on the review of the last quarter, for us, layer 2s and sidechain expansion is crucial because the opportunity is huge. Next slide, please. On the demand side, we saw how DAI demand was reduced during Q1. Again, mainly because of Terra. Terra plus Anchor were eating the stablecoin market. After Terra collapsed, we saw a new challenge coming, and it was that the stablecoins market and everything in general, because of the bear market, was kind of freezed. And regarding stablecoins, projects, institutions, companies in general are being more cautious because they don't want to face another Terra collapse. So we are seeing a lot of companies and institutions asking more technical details and economical details about how DAI is backed by and how Maker works. And this is interesting because it is the first time that we're receiving that kind of requests from our partners. I think it's an interesting opportunity for us because of all the security that Maker has. But at the same time, we need to have more researchers and more probably universities writing about Maker and explaining how Maker works. And right now we are working on it, and we want to have articles by different companies, institutions that explain why DAI is different and why over-collateralized stablecoin is different than an algorithmic one. We have seen that as an important and something that people are requesting right now. So during Q1, we saw that Avalanche reduced rewards on DAI, that reduced drastically DAI liquidity on Avalanche. Same happened in Polygon because Aave is not giving rewards anymore. So we saw as well like DAI liquidity completely like reduced on Polygon as well. So this is just like to show what everybody knows, that people are looking for rewards, and that is what helps liquidity to increase. During permissionless, we had meetings with Avalanche, and thanks to that, we got rewards for DAI on Avalanche, and this situation that we are seeing on Q1 changed drastically right now, like the DAI liquidity in Avalanche and Optimism, thanks to Velodrome and other liquidity initiatives, has increased by a lot. And interesting thing and another opportunity for us is that we have been talking with these side chains and other networks, and after what has been happening with bridges, they are saying something interesting and something that they need, canonical DAI. They are super interested on having like canonical DAI on these networks instead of having a wrap version and using a bridge, because as you know, bridges are like a honeypot, and hackers are after those. So they are super interested about Maker Teleport. We have been having a lot of conversations with different bridges and also networks, like for example Avalanche, that have expressed their need of having a solution like Maker Teleport to avoid all, to protect themselves from all these hacks that have been happening on the bridges. We have been also seeing a slow development on the layer 2 ecosystem, and I will say in all the crypto ecosystem, but it is because the bear market, we have seen this before. We know that everyone now is just like focusing on building, and that is interesting, but also we will see a slow development on these other networks. Next slide, please. About what we have been doing for Q1, you can see all this more in detail in the forum, but we had like a very interesting first integration in Japan. We have been working with different exchanges in Japan for the last, I would say, 3 years, because for Japanese exchanges to list stablecoin or any other cryptocurrency, these currencies have to be approved. And during Q1, we got the approval of DAI and MKR, so both were listed on the first Japanese exchange, of course. And again, after what happened with Terra, we have seen regulators like thinking differently about stablecoins and asking more questions than before. So we will have to follow that up to see how this evolves in the Japanese market. And actually in all the markets, we have seen how regulators are like asking more questions about stablecoins in general, as I explained before. We also have been continuing with the expansion of listing DAI with other important pairs as ETH and BTC. We have been doing that in Bybit, which is another important exchange from Asia that has a huge presence in Latin America. And we have seen how they repeat the same recipe, which is offering high yields to attract new people to use certain currency, in this case DAI. So again, like this just like proves how a DSR or any yield solution, it's what moves the market and attracts new users to certain cryptocurrency. We also have been working a lot with the Maker brand. Well, during Q1, we started to reactivate the MakerDAO Twitter account. We also have been sponsoring different events because we have seen a lot of new people, newcomers to crypto that are not aware that DAI is part of Maker. So we are working a lot with PR agencies within these events to re-explain to these newcomers about what Maker is, what DAI is, and like link the idea about Maker is DAI is part of Maker. We also started sponsorship, the Bankless podcast. If you see it in YouTube or listen to the podcast somewhere, you may see that I think once every week they mention Maker and they explain what Maker is, and then they talk about DAI. We decided with this brand strategy to start talking about Maker and DAI, not just about DAI. We think it is important to generate that connection of ideas whenever we talk about Maker or DAI. Next slide, please.
Before that, Nadia, sorry, we did have a question come in. Probably relates a little more to the last slide, but a little bit on this one. Patrick was wondering if other protocols have commented on a willingness to pay fees from Maker Teleport, I guess on the L2 integrations there.
We haven't talked about the fees because that is not a decision of the protocol that integrates it, but it's more a decision of the user. Usually bridges or the protocols that work as a bridge, they integrate different solutions. We are positioning Maker Teleport as the bridge for DAI, for canonical DAI. So in the end, it will be the user who decide what they will use, what they prefer to use. So I imagine that in the future, we will see some sort of 1 inch or like bridge integrators offering different possible bridge solutions at a different price, and the user will decide what is the bridge that they want to use. I think the big difference and something that no one else can offer is that we are teleporting the canonical DAI and not a wrap version. So I think that is an important differentiator between Maker Teleport and other bridges. And also, I expect that Maker Teleport at some point evolve to include other stablecoins that we have in the PSM. That would be incredible, because with that solution in mind, I think there's no problem at all that we charge a fee, because we are not bridging wrap versions of stablecoins, but like the canonical version of the stablecoin. And that is something that Circle is looking for, that all the chains are looking for, because they are seeing that people are moving stablecoins between one chain and another. And if they can reduce the risk of hacks, that is what they care about. Thanks to all the hacks that they have seen, now the Maker Teleport has a lot of value to offer. So I think I wouldn't be worried about the fees, at least for now.
Excellent. Well, sorry to break your flow there, but appreciate that detail. Here's the next slide.
Okay, so as I mentioned before, we started working with PR agencies, and we are super interested about understanding what the media is talking about Maker and DAI. And this is important because unfortunately, in the end, what people knows about something is what they read on crypto Twitter, or they read on any media outlet. So I think it's important to analyze what the media is talking about Maker and change that based on what we want them to talk about that. So one important finding was that media is not talking about real world assets or Maker as a DAO. And I think these two are I would say, two biggest differentiators that we have against other stablecoins. The fact that we are completely decentralized, I think that is something that we have to start talking even more. 2% of the things that media talks about DAI is about Maker as that decentralized protocol and all the decentralization process. And the other thing that we notice, thanks to this brand analysis, is that whenever the media talks about DAI, they don't talk about Maker. So that is one of the reasons why these newcomers are not linking DAI with Maker. And we want to change that. We want that whenever they talk about stablecoins and the media talk about DAI, they just don't compare DAI with USDC, because we think they are different stablecoins, and Maker vaults behind DAI are an important feature of DAI itself. So this is just the beginning of the work we are doing with the agency. This is important because this gives us a perspective of where we are. And with this in mind, we can develop a plan of what we want in 3 months, in 6 months. And we will be following this plan with the agency to improve the way how media talks about Maker. So we want to have more articles talking about real world assets and the decentralization of Maker and linking DAI plus Maker vaults. Next slide, please. So this is just a brief summary about what's ahead of us. From the supply side, we will continue with institutional vaults, and we want to help the protocol to move multi-collateral DAI vaults to other domains. We have, whenever we talk with Polygon, Avalanche, Gnosis, you name it, they are super interested in working with us. They are that interested that, just to give you an example, Polygon is willing to help us to cover the surplus buffer that is needed to increase the debt ceiling on Polygon once Maker vaults are there, which I find super interesting, because it's like a real partnership between Maker and the sidechain where we decide to deploy Maker vaults. The challenge, of course, here is that market conditions are slowing down everything. Also, after we posted the alpha institutional vault, protocol engineering suggested that we should start smaller with institutional vaults, like instead of starting with 200 million with one new vault user, we should start like with something like 20 million and see how it goes and be able to manage the risk associated to a large vault position. So this also will slow down this process. Also, well, as you have seen recently, the market committee decided to freeze stability fees for 3 months. So we will use that as a marketing campaign, as a marketing initiative to attract new vault users to Maker and convince them to use Maker vaults to like be more familiar with it. And the next step to open an institutional vault, and in that way we will be able to reduce the risk associated to these large positions. On the demand side, one opportunity that we identified was that everyone is looking for a trustworthy way to move stablecoins between chains. So that means that Maker Teleport is like the perfect solution for this opportunity, but we will need to work on adding more domains to the teleport. And from a brand perspective, well, you have seen the impact of having alive the MakerDAO Twitter account. We think that was crucial to communicate announcement with different stakeholders. We would like to do the same with the MakerDAO website. We think we have to have a website active, and that is part of the plan of the brand team inside the Growth Core Unit. We want to link the Maker concept with the DAI concept. We want to position the DAO. We want to position Maker as one of the main DAOs in the system, and position DAI as an over-collateralized stablecoin and not an algorithmic one. That, of course, has some challenges. We have to define Maker's main message and narrative. We think we kind of forgot about that, and there are different initiatives inside the DAO to help us to define it from the inside, and we will use that as an input to convert it into a message and narrative that we will push to the outside. Of course, we have to educate our agencies, although we are working with one crypto PR agency and one more like mainstream. They think they understand crypto, but they really don't. So we have to go like deeper and to explain to them that we are not just like a regular stablecoin, that we are Maker and all about decentralization. And by the way, this education initiative is not just for agencies, but also for these companies that will start opening vaults like Alpha, all these Bitcoin miners companies. Unfortunately, it is probably the first time they heard about Maker, and it is the first time that they know that they can use their crypto as collateral to mint DAI. So there are a lot of education opportunities down there to explain to them about Oasis, DeFi Saver, how to protect their positions, how the Maker protocol works, liquidations, also educate their compliance teams to explain to them why they don't have to KYC Maker, why we work as a DAO, why it's not needed because they are using their collateral to mint newly DAI. So there are a lot of educational efforts that we're doing right now within the ecosystem. And it is super important that we update the Maker's website to show to everyone everything that we're doing. Maker's website is completely outdated, and if you see it, they don't talk there. Like when you go to the Maker website, you may see a lot about DAI, but you don't see anything about Maker vaults. And we think we are losing a lot of opportunities because of that. That was it for me.
Thanks, Nadia. I'll briefly cover the ETH on-chain lending market. So we saw a continued deterioration in Q1. It took a nosedive on the last day of the quarter, actually, when Nexo withdrew about 340,000 ETH tokens from the protocol. Compared to last month, quarter, and year, the ETH lending market is down 14%, 24%, and 19% respectively. On a year-over-year basis, Maker's market share decreased by 9.4%, along with Compound at 9.2%, with Aave being the primary beneficiary, increasing their market share by 10.3%. Aave recently ended their liquidity mining program, so it'll be quite interesting to see how the borrowers and broader lending market react. Aave and Compound have collectively spent over $500 million on liquidity mining incentives, whereas most people here know that Maker has spent nothing. The Maker protocol's rates should be much more competitive and attractive now compared to Aave, and will continue to be more competitive as the liquid ETH staking market matures and supply liquidity moves from ETH to staked ETH. Because if you look on Aave right now, you are getting yield from depositing ETH, and there's no yield from depositing and supplying staked ETH. So, in my mind, liquid staking derivatives will overtake ETH as the asset to be used within DeFi, and that will benefit Maker relative to competitors. So on the positive side of things, we are starting to see some signs of life in the ETH lending market, though all bets are off if the broader macro markets continue to remain bearish. Through today, 7th of June, ETH locked-in Maker has increased by 14% relative to Q1. So much of this increase is likely driven by the value of ETH falling and more collateral being needed to back DAI loans. But nonetheless, it's good to see that trend start to bottom out and reverse a little bit. And hopefully, if markets turn around, more DAI will be minted, and the revenue and associated financials will rebound. I'll now pass it over to Adrian to cover the wrapped Bitcoin lending market.
So wrapped Bitcoin, in contrast to ETH as a lending, as a source of lending business, has taken on a slightly different trend relative to last year. So we see much stronger growth in the overall WBTC lending market. And in fact, we see quite a strong growth in WBTC supply, which sort of drives the total addressable market for Maker to begin with. In terms of share growth, sort of the last minute change that Nadia mentioned from Nexo put Maker down from first place to third place in market share relative to Aave and Compound, but still at a fairly substantial position relative to last year. And remains to be seen how Aave is able to sustain this position without relying on sort of mercenary capital to keep users in the vault. The other trend that we're seeing in the overall BTC lending market is actually off Ethereum, still crypto native, but more in the sort of TradFi space, with players such as Genesis taking on crypto collateral and issuing loans in this space. So this will be one trend to watch out for as a source of increased competition. But even in this regard, what we're seeing is that Maker rates are considerably more competitive than our centralized alternatives.
Here we see the total net stablecoin borrow in the top 4 lending protocols on Ethereum in 2 of the largest segments. On the left, 10 million plus borrowers, and on the right, borrowers of between 1 million and 10 million. And as you can see in both of these segments, Maker has been dominant, but this dominance has been decreasing since about November. At the bottom here, you can see those 2 segments again, as well as 2 smaller segments of less than 100K borrow and between 100K and 1 million borrow. And for those segments, Maker is more in line with Aave. It's actually behind in the less than 100K borrow segment, where Aave has over twice the amount of customers in that segment, but really only 15% more in total dollars borrowed. So you can see that they as of right now, they are catering to the smaller borrowers a little bit better. But it doesn't really make much of a difference to us because those numbers are all small anyway. One other thing to note is that in the largest segment, it was only in this quarter that Aave overtook Compound. And we might see that turn around now that Aave liquidity mining rewards are over.
Now let's look at the L1 stablecoin market share. So this is the KPI we saw earlier on the transaction volume of DAI. As discussed, it's quite flat, always around 10. There was 140, but it's just a glitch. So not a lot of changes. The metric is quite volatile month over month. What is interesting is that we can see that USDC over the last year grew its market share against USDC against USDT, which is kind of obvious for us. It's sad that DAI didn't take much more than USDC, but things are as they are. So next slide, please. Going on L2s, we can see that, so that's the amount of DAIs in circulation on those L2s on both Arbitrum and Optimism. The situation was already described on the ALM liquidity report, but it's still DAI is still super growing, not as fast as the other on Arbitrum. That's mainly due to the fact that DAI is not on the Stargate liquidity farming, but USDC is. And same thing on Optimism. We were quite good on Optimism, and then there was Stargate, which didn't give reward for DAI. So that was kind of a loss for us. That's about it. But some people think that the Velodrome protocol launching soon, or was launching, and may attract significant liquidity. So we will see. I didn't check lately. Next slide, please. Same thing almost for the other alternative chains. We can see that on most chains, all chains actually, USDC is the main stablecoin there. USDT is the second, but most of the time the third. And then it is DAI that is second or third, depending on the platform. There is still a lot of DAI in Avalanche. I think it decreased a little bit due to the end of liquidity mining on Aave, but that came back. So there is always some kind of fluctuation. And that's it. Next slide.
Hey guys, TJ here from Real World Finance. I'm going to be overviewing the state of the nation in our neck of the woods. Last month, we had a significant uptick in the utilization of existing vaults, primarily driven by success onboarding of a Tesla collision center, as well as New Silver continuing to execute their business, onboarding bridge mortgages in the US, and finally Consul Freight finally tapping into their facility. I believe they were literally financing a meat shipment, which is great for this bridge between DeFi and meat space. In regard to existing vaults, we're expecting a New Silver increase on debt ceiling. We're talking to them now, but what that looks like, it does appear they have secured a large mezz slice from an established institution that we're familiar with from our old world in TradFi, which is great. Moving forward, as we look at the pipeline, we really have a kind of unblemished or a kind of a ruthless focus on scalability, right? We want to become this wholesale lender, build out various implementations, and be able to run volume through them as opposed to doing one-offs, right? We think about what can scale as the decentral bank, laying these pipes between the real world and DeFi. It's very obvious that underwriting on an asset by asset basis is untenable. So we look out ahead, Huntington Valley Bank is kind of deep in negotiations. Term sheets have been agreed upon. Agreements have been drafted. We're sending a draft over to HVB any minute now, hoping for a soon publish. SocGen risk assessment was posted recently by Eric and Christian Peterson, which we're really excited about. And the rest of the opportunities in the pipeline are really geared on this scalable wholesale model for the most part. If things go as we expect them to, SocGen and HVB should both be online in Q3. That will represent a 5x increase in total Maker assets and about a 3x or 4x increase in total revenues by the end of Q3. We're not going to act like we can see the future. There are always unknown unknowns, but things look like they're moving along pretty nicely, and we're looking forward to the next quarter. Next slide, please.
Yeah, okay, I guess it's me. So here's the protocol engineering update for Q1. PECU accomplishments, Q1. So we completed the institutional vault contract development. We completed the D3M development, which is now in audit. Completed DSS crop join to support distribution of token rewards. This is for the Curve STETH vault. Created formal verification specs for the Maker Bridge, DSS wormhole, which is now Teleport. We completed the Curve Oracle deployment. Technical accomplishments. We updated the ESM with a new 100K Maker threshold, engaged with third parties to set up the Keeper network, built a rate limited flapper to limit parallel flap auctions, enhanced processes to work with other engineering teams for collateral onboarding, and completed the TUSD offboarding. Upcoming priorities for the team, D3M completion, following chain security feedback. This is for the version 2 of the D3M. Optimism Arbitrum fast withdrawals deployment on mainnet, that's coming soon. DSS gate completion pending updates from Deco and audit review. We have PAX-G onboarding pending feedback from chain security and ESM simulation activities. This is kind of a roadmap picture for what we're looking at for loose timelines of where we're wanting to go with the cross-chain multi-chain strategy. So this involves going wide to various protocols. We have sort of Optimism, Arbitrum, and Starknet in active development. And ideally, we want to move to these popular chains, potentially side chains as well, Polygon POS, Gnosis Chain, and Avalanche. The Maker Teleport is the other big piece here. This will enable sort of high throughput, low cost DAI transfers between these chains. We believe that, sorry, I'm speaking somewhat on behalf of myself, not the PECO team with this stuff. Yeah, it is the belief that there will be, stablecoins will be sort of the main coin that is transferred between these chains, and we want to position ourselves as the go-to superhighway for doing this.
All right, we'll wrap the call up with Adrian walking through our investment opportunities and kind of how we're looking at prioritizing things.
So in this slide, what we tried to do was summarize some of the key initiatives that are taking place in DAO in terms of business opportunities, and find a way to summarize the total opportunity for the project and the expected, compared to the expected effort that it might take to get there. So to walk you through this table, what we have on the left-hand side are each of the initiatives in ranked by rows. Then what we're doing is we're taking essentially a sort of max debt ceiling as a total estimated reach. We have an expected yield, a return on these assets, estimated or approximate capital at risk metric with the corresponding sort of equity required to buffer for that risk, and the associated return on equity that the expected yield will generate. What that gives us is an estimated year one revenue, And so Makerman, the way we took the expected yield on ETH staked ETH is summarized in Seb's balance sheet approach to ALM post. I think maybe if someone can find the post and link it in the chat, I think that would be helpful. Lost track. So estimated year one revenue, and then we have a heuristic for estimated effort from 1 to 5, and then we find a So we'll get back to the point later, and maybe Seb can speak to this a little bit more. So we have an estimated effort heuristic, and the way that we're thinking about this in the absence of a sort of clear way to get a sort of NPV equivalent result is to basically take the expected year one revenue divided by the effort heuristic, and then divide that by the equity. So in essence, what we're doing is ranking the relative importance of projects on the basis of maximizing the revenue per effort required and minimizing the equity that needs to be locked up to buffer for that risk. So here, what this table demonstrates is that employing our assets productively is and should be our first priority, because it basically generates the most amount of revenue per effort per equity. Right, so this goes in the direction of deploying the balance sheet more productively, investing in short-term bonds, and depending on the outcome of MIP 55 C3, investing part of the surplus buffer to further the objectives of the DAO. Then the second order of priority for investment opportunities are our bread and butter, so institutional vaults. Layer 2 expansion and DeFi money markets, so direct integrations with crypto native protocols. And then in last but not least place, I think the ranking on RWAs is largely skewed by the large amount of equity that needs to be tied up to buffer for that risk. And I think this speaks to Tij's earlier point about the need to pivot towards a more wholesale lending approach, both to protocol integrations and to RWAs. In order to make sure that we're earning an attractive enough return on equity for our efforts. I see some chatter in the chat. I don't know if there's anything that we want to speak to live.
Mostly addressing the yield opportunities. So if you don't have anything to add there, I'll keep an eye out for questions.
Yeah.
One of my questions was on under collateralized loan lending, and this would indicate a pretty significant departure from, at least from what I understand, the philosophical basis of MakerDAO. So how are we going about making this call as a community in a DAO?
So maybe it makes sense to invite Teach to address this, not to call him out.
Yeah, can you guys hear me okay? My service is not great. I think I heard the question correctly. It's regarding under collateralized lending and the consensus in the DAO. Is that right?
Yeah, it's just what I personally see it as a departure from the over collateralized philosophy that MakerDAO has held for a long time. I'm not saying we don't do it. I'm just trying to figure out, how do we know we've made that decision to do this, or what's the plan to make that decision?
Yeah, so that's a great question. I think ultimately this particular question has not been addressed with the intensity it needs to be addressed with, but I do think a level of nuance needs to be brought to the discussion. So if we look at something like a Maple, right? A Maple is primarily focused on market makers, arbitrageurs, and it is under collateralized in that there is no security being pledged, right? But ultimately we will have agreements in place whereby those parties have obligations to us. If you think about something like trade finance, right? A lot of trade finance is done unsecured technically, but you're also ultimately secured by cash flow or a commitment to repay a receivable, right? And to me, it's actually very similar to that. On top of that, I think going straight to an under collateralized or uncollateralized model is probably unpalatable for the community, which is why, at least for now, in my role, I am focusing on a initial integration that has some crypto collateral involved. This is kind of the type of crypto collateral the DAO is super comfortable with in either WBTC or ETH. So that will be an element in any V1. But Robert, I think you kind of get right to the core of the issue here, which is, do we as a community, have we discussed the principle of moving from a fully over collateralized model to something that is less than that? And I don't think we've answered that, and I don't have a good answer for it.
Yeah, to bring up the points on the side chat too, this is not the same as like an algorithmic style under collateralization of the token. It's very different. And I think we should use the, who was that? Seb brought up the word unsecured, which I think is probably a better term for this. Because like we can still liquidate this, as long as it's operating correctly, we can still liquidate this and eventually get back the DAI. It's not like it's not there. So like there is a difference.
Thanks, everyone.
Yeah, sorry, playing at devil's here. Wouldn't it make DAI more hard, for lack of a better word, if we stay away from under collateralized loans? And I'm just saying that because I think the new American bill that came out for cryptocurrencies wants hard assets to back stable coins. It hasn't been defined yet, but I kind of see where Robert was going with his question.
Yeah, I mean, this stuff is not like, there's also lots of like nuance in it. So it's not like you have collateral and then all of a sudden you're safe. Like there's different quality collateral. So we're all used to like crypto collateral. It's pretty hard, but like, you know, you can have collateral that like becomes like underwater for various faults and stuff like that, just because it's not good collateral. So like these terms are a little bit kind of loose, I think. And so it's not quite as cut and dry. So like having some exposure to various opportunities, I think is wise. And we sort of limit our risk by sort of evaluating the total, like the risk of the asset on its own and not like looking at these labels so much and just figuring out how much exposure we want.
Yeah, and I would just add to Sam's comment by saying that for me, like the goal is ultimate proliferation of DAI. And to do that, we're going to have to probably maximize a little more for capital efficiency. So I think this is a market that ultimately we should want to play in. Otherwise, it's going to be hard to scale DAI as quickly relative to other stablecoins. And if we also want, you know, DAI to be accessible for the masses, we're going to need, you know, to proliferate quite strongly, right? And you know, having that level of accessibility is probably going to be, you know, something we're going to need, like going this route with these, you know, unsecured type of lending products.
Just add on to Mark's comment here. Again, not something like all of these ideas have, as far as I'm concerned, not been officially explored or agreed upon by the DAO. But ultimately, to me, DAI needs to be a network, right? And for money to be a network, it kind of needs to live everywhere. And so whether you're determining collateral as a hard asset or, you know, some sort of intent to pay cash flows, I think ultimately we need to think from, if DAI succeeds, it needs to be everywhere, ubiquitous, a network. And how do we back into that today? Yes, it is be super safe and be over collateralized, but also you need to take the opportunity to ensure DAI lives everywhere. And I think that takes a mixed approach personally.
Also appreciate all the responses. Looks like we've more or less run through questions. Do remember you can raise your hand or drop them in the sidebar. But if there are more slides to get back to, happy to toss it back your way, Mark.
Yeah, this is the last slide of the presentation. So if anyone has any questions on, you know, any of the slides or any topics we discussed today, I think anyone here can probably, or hopefully, give you a decent answer to any questions or concerns people have. Yes, Frank.
But with regards to that, the short-term bonds, can you just give us I know you guys spoke about this before, I think maybe on the forum or Discord. How did you come up with the maximum debt ceiling for the PSM? I see you have 2.5 billion. Can you give us a scenario where that drops to 2.5? Where do you drop it to? 2 billion, I guess. And how did you guys come up with the 2.6? I would imagine those are T-bills. Was that because of what Monticello is doing with, I can't remember the Scottish company, the money manager. Yeah.
So on the 2.6, it's coming from one of the ETF we are looking for. So it's not coming from a by default, which is more on the credit side and wasn't approved yet. So we just took a treasury bonds 2-year average maturity, and it was currently it's 2.6%. It's increasing slowly over time. Yeah, and if you go shorter term, let's say 3 months or a bit below, it's 1.2% increasing faster.
And regarding, I think the question on how we sized the debt ceiling, I think this was just a rule of thumb heuristic to make sure that so here it'll be a balance between optimizing for yield and optimizing for liquidity of the PSM. Ultimately, the stability of the I has to win. So in this instance, we sort of reserved anywhere between half to 2/3 of the PSM to be available for generating a yield. But I think this function could be optimized depending on market conditions by Maker governance.
It depends on the friction to go in or out short-term bond. If the cost is 50 basis points, obviously we will keep a way larger buffer in the PSM to avoid moving in and out too quickly.
Yeah. And also liquidity, right? I mean, the end game here, along to steal a phrase from Rune, is to have all these bonds on chain. And we are, discussing with various startups and I think other institutional asset managers that are interested in making this a reality. But yeah, we're a long ways from that, in my belief. But ultimately, we do see a future where there is, tremendous liquidity on chain. And until we get there, we have to be, quite conservative by keeping ample liquidity in the PSM to, absorb any shocks in the demand for DAI.
Yeah, so to Kianga's question, which is a very good question, obviously the minute that we, so from our point of view, the minute that we on-ramp to fiat, we are exposing ourselves to credit, not just credit risk and centralized counterparties, but also a myriad of potential risks associated to having the funds fall outside of Maker's control. Sam's point that tokenized their real world assets, such as a hypothetical tokenized bond ETF, would be the holy grail provided it had enough liquidity. So hopefully we can steer clear of so it's important to start, and in starting we should have more than one partner, and this way we can distribute some of that credit risk, some of that centralization risk. But ultimately the holy grail really should be fully on chain, permissionless trading of sort of tokenized assets.
And to add to that, I mean, even on chain, if it's a real world asset, there is always a custody risk. And at some point, well, there is it's not possible to take no risk. Even the real world is taking huge risk currently with a clearinghouse of the 3-party repo. And it's a systemic risk, everyone agree on it, and there's no solution for that. So for instance, currently, two main counterparty risk are Circle with USDC and BitGo with Wrap Bitcoin. No one ever made any analysis of them, and we are quite still happy with it. And we say, well, it's selling the effect and so on. We can do better, and we should be sure that we have great counterparties. So for short-term bonds, it will be the custodian will be a bank, so regulated. So that's the best we can do. But at some point, it's not possible to have zero risk, that's for sure.
Yeah, echo Makerman's views on having multiple partners and multiple national jurisdictions as well to play into that mix.
Yeah, so on that point too, something that's pretty neat that we are building into the HVB deal, should the community approve it, is all idle cash in that structure held by the trustee will be invested in sort of their standard money market short-term vehicle for their clients' cash. So you kind of got a nice versatile beast there. It'll be either earning on real-world assets for the sake or to the benefit of the protocol, and if it's not earning, it'll still be mobile, still be clipping a nice coupon, which will be ultimately returned to the surplus buffer. So I think the key here is, let's explore a variety of strategies. They're not all going to be tokenized right out of the gate, but eventually, if we really kind of explore a multi-channel strategy, we will back into one that is the right balance of safety and on-chain.
We're coming up on the end of our scheduled time here, but if there are any other questions or comments we wanted to get out there, especially for the recording and people watching later, that would be a good time to bring them up. All right, not seeing anyone flood to the gates, so huge thanks to Strategic Finance for kind of organizing this, and for everyone who presented today and answered questions. Obviously, we can keep the conversation going in the forum. Anything you wanted to plug, Mark, before we close out?
No, just appreciate everyone attending, and yeah, look forward to posting this recording as well as the materials on the forums, and feel free to reach out Discord, on the forums, if you have any additional questions.
All right, thanks everyone. See you next time.
Right.
Thanks, guys.